Okay, in this video, we're going to talk about tax accounting, cost accounting, chart of accounts, and the tax accounting first strategy. This is an outline of the dialogue I'd have if you and I sat down to talk about a bookkeeping strategy for you. And I'd have this conversation pretty much the same whether you were a novice bookkeeper or new to small business accounting, or if you were an experienced bookkeeper. It just makes sure that we have baseline on vocabulary correct, and then I very quickly skip from topic to topic to connect um, very large picture views to how this actually rolls out and plays out in Zap accounting software. So here we go. First of all, there's two types of accounting. There's tax accounting and cost accounting. Tax accounting is also referred to as financial accounting. Cost accounting is also referred to as managerial accounting. Tax accounting is accounting for your income, expenses, and owner draws to properly self-report your tax burden. Tax accounting is also required, right here, tax accounting is also required for company reporting of finances. That's where it takes on that term financial accounting, and I'll hit on that just a little bit more below. Cost accounting, on the other hand, is accounting for your own personal use. It is done to assist you with assessing all aspects of your business as you deem worthy. Okay, so what are the major differences between tax accounting and cost accounting? Tax accounting is for the tax man, with income, expense, and cost of goods sold categories set by the IRS. It is required. Cost accounting is for yourself with categories set by you. It's optional. Now, I'm using the term categories. In the tax accounting world, what I'm talking about is the categories that you'd assign to each transaction. It's easiest to think about this for expenses. You have an expense and you assign it to a category. That's a generic, non-technical accounting term. The category for tax accounting is actually related to the line items on the tax form that you're required to fill out. A category in cost accounting is typically referred to an account as in an expense account. Okay, so these three terms are somewhat synonymous. I will use categories more than I will accounts, and I recognize that that's not the proper way to use vocabulary in accounting, but it makes more sense. You're going to categorize transactions. That's what you do. Okay, so the typical small business bookkeeping process is set up for cost accounting first and tax accounting second. What do I mean by that? In a new software setup process, it asks what kind of business you have, and it generates a massive list of accounts that may not really be relevant. These accounts are going to include asset. Looks like I got a misspelling there, right? Liability, owner equity, income, and expense. And for the purpose of this in your head, just focus on expense accounts for now. In other words, I go out and I spend a bunch of money on different expenses for my business, and I assign those to different accounts. Okay. Now, this concept of being able to click a couple buttons in software and say generate a chart of accounts for me sounds great. The problems are numerous with this. First of all, it typically creates too many categories. Oftentimes, the categories created have conflicting vocabulary that may be foreign to you and those who you do your books. The example I always use is vehicle, car, truck, or automobile. In other words, some people talk about vehicle expenses. Some people talk about car expenses. Some people talk about automobile expenses. And if it splatters vehicle all over everything, but you want car, you're going to go back and change. But if your bookkeeper uses a different term, they're going to get confused, a little confused and lost. And that's only one of, imagine 20 or 30 kinds of vocabulary scenarios that come into play. So these are the problems that I see with doing cost accounting first and setting up charts of accounts. Let's see what I have here. Income, expense, and cost of goods accounts get mapped to tax line items, income and expense categories, behind the scenes and or after the fact. So what I'm talking about is in a typical small business bookkeeping process set up for cost accounting first, you create arbitrary account names that please you or your bookkeeper. And then behind the scenes or after the fact, you recategorize all of the transactions in those accounts and assign them to new and different categories that are required by the IRS on the line items on the forms for tax accounting reporting. Okay, this is how everybody I've ever encountered in small business does their books, and in my world, this is wrong. Now, it's wrong for the new person to business, the small business person. As your business grows and things get more complex, and you bring on accountants full-time or full-time bookkeepers, this has merit certainly. But for the people that I'm trying to attract and help to get going, this isn't a good approach in my opinion. Okay, so the problems with small business bookkeeping start with bloated charts of accounts and vocabulary issues. Bloated charts of accounts with too many expense accounts that create unnecessary confusion and overlap. And I've got links to 2 different websites where they're talking about chart of accounts. Maybe I'll pop this one up in a second and show you what a long list of accounts looks like. In fact, I have it over here. So if you look at this, these are all expense accounts. It's hard to see. Let me blow this up a little bit. Okay. So this is an example chart of accounts from somebody who's maybe providing some QuickBooks support or something. A sample contractor company balance sheet accounts, kind of an odd balance sheet accounts, but oh, it's because they're just for the balance. Those are the non-income expense. Let's see, where did that expense? Okay, so look at this list of expenses. Starts with advertising, bank service charges, but look at, so every time you categorize an expense, you're going to have to go through this long list of expenses and find out where you think it belongs. Okay, so that's a good example of a bloated chart of accounts. Now, we've already covered vocabulary problems. One in this case, I'm going to use a different example. One person refers to postage as shipping costs, another calls it postage, and a third might call it an office expense. Okay, other problems with small business bookkeeping include legacy income and expense accounts as bookkeepers are changed out. So sometimes instead of changing names on categories, like changing postage to shipping, they don't want to do that because they don't want to affect historical reporting. So they just archive the account. They basically make it a dead account and create new accounts, and the chart of accounts just continues to bloat and grow. There's other issues that are related to doing your cost accounting first. I have some of those listed here, but let's keep moving on here. So what is the tax accounting first strategy? The tax accounting first strategy has to do with using the taxman's required categories for your income, expense, and cost of goods sold account names. The benefits to this is it shortens and simplifies the chart of accounts. It eliminates vocabulary confusion and overlap. It creates an income statement, which can be easily used to transfer information to your tax return or cross-check your CPA. And then I have a note here. It says, if the limited chart of accounts doesn't give you the resolution you want or need in your accounting, you can add sub-accounts or recategorize with another column or field any way you'd like. So the point here is that by using this strategy, we're creating a very limited chart of accounts, very few options to categorize things in. If it doesn't give you enough resolution, do anything you want outside of it. Just leave that alone so that you have your tax accounting done with your basic bookkeeping process. Okay, so where do the categories for the tax man come from? Well, they're defined by the tax forms themselves. It's amazing once you get back to the source or the root of what you're doing and why you're doing it. In this case, we're doing tax accounting for the tax person. When you go to the forms, you realize they're not all that overwhelming. In fact, they're really quite simple. If, for example, if we look at the form for Schedule C, this is profit or loss from a business. So every different business venture you're involved in, if you sell lemonade for one business, but then you also do personal training, you would fill out 2 Schedule Cs, one for each business entity. Now note, these are for sole proprietorships. They're also for partnerships and LLCs and LLPs. There's a different form for S corporations, which small companies often are, but you'll see the S corp form is very similar to this one, in fact. So if we look at this form, there's an income section. The income includes gross receipts, your sales, returns and allowances, and then this is subtract 2 from 1 gets you a net sale. Then you have some cost of goods sold here. Though your goods you sell are not recorded as expenses at first. They're actually recorded as an asset, and they can convert to expenses as you sell them. Or I'm sorry, I'm sorry, I made a little misstatement there, and I'm not even sure I'm going to get it right this time. When you purchase items that you're going to inventory for sale, they are recorded as an asset, and then when they're sold, the asset account decreases, okay? So anyway, what you end up with is a gross profit, and you have a gross income. Now come the expenses. These are the easy ones for all of us to imagine. If you look through their list from 18 to 27, there's only about 19 items worth of categories for expenses. But if you really read it, what you'll see is there's very, very little overlap. In other words, when you have an expense and you try to categorize it, you're going to find there's only one category, maybe 2 that apply, okay? So it makes categorizing your transactions incredibly simple. Now, there's one comment I want to make while we're here, just to bring it to your attention, and then we'll move on. Travel and meals only count 50%. I'm sorry, meals and entertainment only count 50%, deductible meals here. Okay, all the rest of these count as face value for their expenses. So if I spend $10 on office supplies, I reduce my income by $10, and I reduce my taxable income by $10. A meal, however, is 50%. So what that really means, though, is if I miscategorize something, the IRS doesn't care. It just doesn't matter to To my tax burden due, it doesn't matter. The only thing that matters is if I were to miscategorize a meal as something else because I'm getting more credit than I should. Okay. So now let's get back on track here. So we've found out where we get categories to the tax for the tax man, but how do we put all this together? Remember, our goal here was, and let me drag this down, give a little header to was the tax accounting first strategy. Our goal is to basically set up a chart of accounts that mimics or uses the taxman's categories for a chart of accounts. In the back of ZAP Part A, positive negative values, and the back of the debits and credits version, you'll see we have sample charts of accounts set up for each type of business that you might be involved in. We have a Schedule C, we have an 1120S for S Corps, we have a Schedule E for real estate investing. We also have a suggested chart of accounts for personal accounting. And frankly, the hardest account to set up is a chart of accounts for personal accounting to keep the expense areas from bloating. We also do have a Schedule A set up here, and I need to add the, I'll move this link over here. A Schedule A if you're going to itemize deductions on your personal return. So anyway, if you look at this, these numbers correlate to the line item that's on the tax form that you have to fill out. These numbers correlate to the line item on the tax form for S Corps. So what we've just done, let's go back here to our notes, is we started with no basic understanding or no common, we presume we have no common understanding of accounting. We talked about two types of accounting. We talked about the major differences. We defined which one was required. Then we talked about how everybody does the optional one first and what kind of problems that brings in. Then we talked about looking at doing the required one first. Where do we get the information for the required one? We get it from the forms. And how do we bring that into our day-to-day bookkeeping? We simply create the names on our accounts, our expense accounts and income accounts and cost of goods accounts in our chart of accounts, actually just mirror and mimic that which are on the tax forms. And we even use the line items, numbers from the tax forms to organize those accounts. So it's taken us 12 minutes, and you now have a strategy for doing your bookkeeping and your books, which is very simple, very straightforward. And it actually, when you're done with your books every month or every quarter, you're actually ready to do your tax reporting. And that ultimately is what most small business people need most first. Okay. Now, if you'll notice, there's nothing in here that's ZAP specific. So this same strategy could be applied in QuickBooks, FreshBooks, any place in a spreadsheet for that matter, any place you're tracking transactions and assigning categories. You could use the chart of accounts, which we've provided over here in the back of the ZAP accounting information. You could use these and categorize your transactions and be ready for the tax person. Now, obviously, a lot of you might be thinking about using TurboTax, and it's really the same thing. That's really what you're doing, is categorizing transactions to get them into those categories. So the next video, we will step a little further into this, and we will get into something that's a little more ZAP specific about setting up the reconciliation process in accounting software.